Most people fear debt. Billionaires? They use it like a weapon. The rich don't avoid loans, they use debt to become even richer. While average people see a monthly payment as a trap, the ultra-wealthy see it as fuel. If you want to change your financial future, you have to stop looking at debt as a burden and start looking at it as leverage. While average people drown in credit card debt, billionaires borrow money to buy assets that make them millions. It is the ultimate financial divide. One group borrows money to buy things that lose value the moment they leave the store. The other borrows money to buy cash-flowing empires that pay for themselves. Which side of the fence are you on? The biggest secret in wealth creation is simple: debt can create cash flow, if you know how to control it. Think about it. If you can borrow money at a 4% interest rate and invest it into an asset that returns 10%, you just manufactured free money out of thin air. That is the exact mathematical formula behind generational wealth. Banks happily lend money to the rich because billionaires already own assets that continue growing in value. The system is inherently rigged in favor of the wealthy. If you have no collateral, the bank sees you as a risk. But if you have millions in assets, the bank will literally beg you to take their money at the lowest rates possible. Poor people borrow to consume. Rich people borrow to acquire income-producing assets. It's a fundamental shift in mindset. When you borrow to buy a luxury car, you're working for the bank. When a billionaire borrows to buy a logistics company, the company's revenue pays the bank back, leaving the billionaire with pure profit. Imagine borrowing $10 million to buy a prime piece of real estate, then letting tenants pay back the loan for you. You didn't use a single penny of your own money to buy the building, yet you get to keep the monthly cash flow and the long-term price appreciation. That is the ultimate financial cheat code. That's exactly how real estate billionaires multiply wealth using leverage. They don't save up cash for 20 years to buy an apartment complex. They find a good deal, secure a massive bank loan, and use OPM, other people's money, to build an empire overnight. In the game of capitalism, speed and leverage win. Many billionaires understand one thing average people never learn: controlled debt can accelerate wealth faster than savings ever could. If you rely solely on your savings account, you are limited by your income and the crushing weight of inflation. But when you master strategic leverage, your growth potential becomes virtually limitless. Inflation secretly helps borrowers. Over time, debt becomes cheaper while assets often become more valuable. Think about it: if inflation devalues the currency by 5%, the real value of your fixed debt actually shrinks, while the physical property or business you bought with that debt skyrockets in price. The borrower wins. Billionaires use cheap money to buy assets that rise faster than interest rates. If a private bank offers a billionaire a loan at a 2% interest rate, and the stock market or real estate market is averaging an 8% return, taking that loan is a complete no-brainer. They are pocketing a massive, risk-adjusted spread. Some wealthy investors even borrow against stocks to buy more investments without selling their shares. This is a highly guarded Wall Street secret. By using their existing stock portfolio as collateral, they get immediate liquidity from the bank. They never have to liquidate their positions, meaning their wealth keeps compounding uninterrupted. The rich often appear to spend endlessly, but much of their lifestyle is funded strategically through debt. That mega yacht, that private jet, that sprawling estate. They didn't pay cash for them. They took out low-interest lines of credit against their massive asset portfolios. They live like kings while keeping their actual cash working in the market. Banks trust people with assets. The more assets you own, the easier it becomes to borrow even more money. It's a compounding snowball effect. Once you cross a certain threshold of wealth, the financial system opens up a VIP lane for you, handing you nearly unlimited capital to go out and buy even more assets. Debt creates leverage. And leverage can turn small gains into massive fortunes. If you invest $10,000 of your own cash and make a 10% return, you made $1,000. But if you leverage that $10,000 to control a $100,000 asset, that same 10% return doubles your initial investment. Tech founders often raise billions in funding long before their companies ever become profitable. They aren't waiting around for organic sales to fund their operations. They pitch a massive vision to institutional lenders and venture capitalists, capturing massive market share using borrowed billions before the competition even knows what hit them. They use borrowed capital to scale fast, faster than competitors relying only on savings. In the modern business world, slow and steady doesn't win the race, it gets left in the dust. Capital injection allows a company to hire the best talent, build the best tech, and dominate the global market in a fraction of the time. A billionaire might buy a mansion using low-interest loans while the property itself appreciates millions. Why tie up $50 million in cash inside a single house when you can borrow that money for next to nothing? That way, your $50 million stays invested in high-yield assets, while the mansion grows in value anyway. Debt is dangerous when used carelessly, but powerful when attached to appreciating assets. It's like a high-powered sports car. In the hands of an untrained driver, it's a recipe for disaster. But in the hands of a professional, it's a machine designed to break records and cross the finish line ahead of everyone else. Consumer debt destroys wealth. Investment debt can create generational fortunes. If you take out a loan for something that goes down in value, you are actively making yourself poorer. But if you take out a loan for something that pays you every single month, you are actively building a legacy for your children's children. Commercial real estate owners borrow millions because the cash flow from tenants covers expenses and creates profit. They don't care about the size of the mortgage, they care about the net operating income. As long as the rent checks coming in are higher than the bank payment going out, the debt is an absolute blessing. Hotel empires, apartment complexes, and office towers are often built using borrowed money. Look at any major city skyline. Those glittering skyscrapers weren't built with saved-up pennies. They were built on a foundation of massive institutional debt, structured perfectly to yield millions in predictable monthly profits. The rich understand that debt is a tool, not an emotion. Average people view debt with fear, anxiety, and guilt because they've been burned by high-interest consumer loans. The wealthy view it with pure mathematical objectivity. To them, debt is just an equation of interest rates versus asset yields. Many billionaires even borrow money to buy entire companies. This is known as a leveraged buyout. They use the target company's own assets as collateral to secure the loan, purchase the business, optimize its operations, and let the company's own revenue stream pay off the acquisition debt. It's genius. Once the company grows, the profits pay down the debt while the owner keeps the upside. This is how corporate titans build massive conglomerates. They take minimal personal risk, use debt to acquire cash-flowing businesses, and reap 100% of the equity growth as the company scales to new heights. Saving alone is slow. Strategic leverage can compress decades of growth into years. If you try to become a multimillionaire just by putting money away in a standard savings account, it could take you an entire lifetime. Leverage acts as a financial time machine, allowing you to acquire tomorrow's wealth today. The wealthy diversify borrowed capital into multiple appreciating assets. They don't put all their eggs, or all their loans, into one basket. They split their leverage across prime real estate, recession-proof businesses, and blue-chip equities, creating a multi-layered shield of cash flow that protects them from market volatility. During crashes, billionaires often borrow even more money to buy discounted assets. When the market panics and everyday investors are selling everything at a loss, the ultra-wealthy call up their private bankers, unlock massive lines of credit, and go on a shopping spree for world-class assets at a heavy discount. When others panic, the rich use liquidity and leverage to expand their empires. A market crash is nothing more than a generational wealth transfer. Those who are terrified of debt hide away, while those who master leverage use the downturn to acquire the very assets that will make them billionaires in the next bull market. Private banks offer the ultra-wealthy special low-interest loans unavailable to average people. If you walk into a bank looking for a personal loan, you'll get hit with predatory interest rates. But if a billionaire walks into a private wealth management firm, they are handed bespoke capital terms that cost next to nothing. Instead of selling stocks and paying taxes, billionaires borrow against their investments. If a tech founder needs $50 million cash, selling their shares would trigger a massive capital gains tax bill from the government. Instead, they pledge their shares as collateral for a bank loan, getting the cash completely tax-free. This strategy allows them to access cash while avoiding massive tax bills. It is perfectly legal, highly sophisticated, and used by almost every single top billionaire on the Forbes list. They don't realize capital gains, they borrow against them. It's the ultimate buy, borrow, die financial playbook. The system rewards ownership. Debt simply helps the rich acquire more ownership faster. In a capitalist society, the individuals who own the means of production, the land, and the equity win the game. Debt is simply the accelerator pedal that allows you to claim your stake in the economy before anyone else can. Every smart loan becomes another step toward greater financial power. When structured correctly, a loan shouldn't feel like a weight dragging you down, it should feel like a ladder lifting you up to the next tier of wealth, cash flow, and financial independence. As currencies lose value, hard assets often rise, making leveraged investors even wealthier. Governments around the world are printing trillions of dollars, diluting the purchasing power of your cash. But they can't print more land, and they can't print great businesses. Leveraging hard assets protects you from monetary collapse. The difference between rich and poor is often financial education, not income. There are plenty of high-earning doctors and lawyers who are completely broke because they don't understand leverage. Meanwhile, educated investors use strategic debt to build massive fortunes on relatively modest initial capital. When leverage combines with compound growth, wealth can explode exponentially. This is where the magic happens. You use borrowed money to buy an asset, the asset generates cash flow, you reinvest that cash flow into more assets, and the compound interest curve goes completely vertical. That's how empires are born. From Wall Street to Dubai, leverage has built some of the largest fortunes in history. The grandest real estate developments, the most massive sovereign wealth funds, and the most disruptive global tech platforms all share one common denominator: they were supercharged by the strategic application of debt. Debt helped create modern business empires, global corporations, and billion-dollar real estate portfolios. Without the credit market, the modern world economy would grind to a halt. The wealthiest individuals don't fight the credit system, they learn its rules, master its mechanics, and play it to win. But remember, leverage magnifies losses too. Without discipline, debt can destroy everything. Leverage is a double-edged sword. If the asset you bought drops in value or fails to generate cash flow, that bank payment is still due every month. If you play with fire without a plan, you will get burned. Many people fail because they borrow for liabilities instead of income-producing assets. They see the rich living in luxury mansions and driving exotic cars, so they take out high-interest loans to mimic that lifestyle. They are financing the illusion of wealth while actively ensuring their own financial ruin. The smartest investors focus on cash flow first, luxury second. They don't buy the sports car until they have a leveraged asset, like a rental property or a business franchise, that generates enough passive income to cover the monthly car payment completely. That way, the luxury item is essentially free. True wealth comes when your assets pay your debts automatically. Imagine waking up on the first of the month knowing that your tenants, your customers, and your business investments have already deposited enough money into your account to clear all your liabilities and leave you with a massive profit surplus. So the next time you hear the word debt, remember this: billionaires don't fear it. They master it. They don't run away from loans because they understand that avoiding debt entirely means limiting your financial growth to the speed of your own savings. They choose to play a bigger, faster game.